Are we repeating the 1997 foreign exchange debt trap, or have we finally learned the math? That's the question. In good times, borrowing in a strong foreign currency looks smart. The rate is lower, investors are eager, and the exchange rate feels stable until it doesn't. Then the bill arrives in a currency you don't print. Revenues collapse in local money, the debt doesn't, and policy choices shrink to three bad options: raise rates into a downturn, burn reserves to defend the peg, or watch the currency slide in your balance sheets with it. That was Asia in 1997. The trap hasn't changed. The plumbing around it has. Let's rewind the tape in plain English. The Asian miracle of the early 1990s ran on investment, exports, and capital inflows. Many countries pegged or quasi-pegged their currencies to the US dollar. The peg reduced FX volatility and lured foreign lenders hungry for yield. Corporates and banks borrowed dollars short-term because it was cheap. They invested long-term at home because the returns looked great. So you get two mismatches at once: currency, dollar liabilities, local currency revenues, and maturity, short funding, long projects. As long as the tide of dollars kept flowing and the peg held, the math worked. Then the tide turned. Thailand's property bubble burst. Current account deficits widened. Reserves looked thin relative to short-term external debt. When speculators tested the bot, the central bank burned reserves to defend the peg and hiked rates to keep capital from fleeing. Higher rates crushed domestic borrowers just as export demand cooled. Once the peg snapped, the currency fell fast. Now every dollar of debt costs many more baht to service. The trap snapped shut. Devaluation worsened balance sheets, which spooked lenders, which triggered more outflows, which drove further devaluation. Contagion jumped to Indonesia, Malaysia, Korea. IMF programs arrived with emergency dollars and tough conditions. The recovery eventually came, but only after deep recessions, bank restructurings, and a lost half-decade for some. That's the template. Are we walking back into it? Parts of today rhyme, parts don't. Start with what's different. After 1997, Asia built war chests. Central banks accumulated large foreign exchange reserves, moved toward more flexible exchange rates, and imposed prudential rules that punish unhedged foreign borrowing. Current accounts improved. Corporate balance sheets in many countries reduced outright dollar exposure or matched it with export revenues. Banking supervision toughened. Debt maturities got longer. The region's plumbing is sturdier than it was, but the world didn't stop inventing new ways to create FX mismatches. The global dollar system, Eurodollars created outside the US, has only grown. When global rates were near zero, the temptation to borrow cheap dollars never disappeared. It just migrated. Sovereigns placed Eurobonds in dollars because local markets were shallow. Corporates issued dollar debt to fund projects with local currency cash flows because the coupon looked lower. Banks promised dollar deposits to local savers and invested at home, assuming that swap markets would always be open and cheap. Private credit funds lent cross-border with covenants written for sunny weather. None of that is scandalous on its own. In a rising rate, strong dollar world, it's a vulnerability. Here's the simple mechanic that turns vulnerability into crisis. Imagine your company earns in pesos, baht, or rupiah and owes in dollars. When the dollar strengthens, your revenue, translated into dollars, shrinks. Your debt service, in dollars, doesn't. To avoid that, you hedge, buy forward contracts or cross-currency swaps. But hedges expire. They cost money. And when volatility spikes, hedging costs jump just when you need them most. If you didn't hedge because the peg is solid or the basis is cheap, you are back in 1997 with better software. Policy also faces the same trilemma it did then. You cannot have a fixed exchange rate, free capital movement, and independent monetary policy all at once. Pick two. If you defend a peg with open capital flows, your interest rate becomes whatever the anchor currency sets, whether your domestic cycle needs it or not. If the anchor tightens aggressively while your economy softens, pain leaks in through the peg. If you float, your currency moves more, which protects your real economy, but exposes balance sheets that borrowed unhedged in foreign currency. The trilemma isn't a slogan, it's a constraint. So what would a 1997 style trap look like today? It might not start with a sovereign. It could start with a corporate with big dollar bonds rolling over in a year, facing higher coupons in an FX hit, or a bank with short-term wholesale dollar funding and long local loans, facing pricier swaps and clients under stress, or a property sector that boomed on cheap foreign currency loans, now refinancing into a market with higher rates, lower demand, and less friendly investors. In each case, the spark is the same. The time when funding was assumed to be always available ends, and rollover becomes a question, not a button. Where are the defenses? Reserves matter, but so does how you use them. Burning dollars to defend a specific level can telegraph desperation and invite a bigger test. Using reserves to smooth disorderly moves while letting the exchange rate find a new level preserves both dollars and credibility. Macro-prudential tools help. Limits on banks' net open FX positions, higher risk weights for unhedged FX loans, stress tests that assume both currency depreciation and rate spikes. Local currency bond markets are a quiet superpower. The deeper they run, the less your best borrowers need to go offshore in the first place. There's also a healthier reflex across much of Asia and emerging markets. Match your debt to your earnings. Exporters who invoice in dollars and borrow in dollars are not really short dollars. They have a natural hedge. Utilities with local currency revenues and regulated tariffs are the opposite. They're fragile if they borrow in foreign currency and can't pass through devaluation. Governments learn this too. Issuing more in local currency, even at a higher coupon, reduces crisis odds because you owe in money you print and tax, not in money you must buy. Still, the global cycle matters. When the Federal Reserve tightens fast and the dollar rises, it pressures anyone who borrowed dollars abroad. That doesn't mean disaster. It does mean sorting. Countries with current account deficits, thin reserves relative to short-term external debt, and large unhedged FX positions will feel 1997 more. Countries with surpluses, flexible rates, and strong local markets will feel a slowdown, not a crisis. The trap is selective, not universal. If you run a business in an open economy, the practical checklist is boring and life-saving. Map your cash flows by currency. If you earn mostly in local money, keep most of your debt there too, even if the headline rate is higher. If you must borrow in dollars, hedge farther out than feels comfortable. And don't let the cost talk you out of it when volatility is low. Ladder your maturities. Don't stack them in 1 year. Avoid covenants that force asset sales on currency moves. Pressure test your model at a weaker exchange rate and a higher coupon at the same time. If it only works when both are friendly, it's not robust. If you're a policymaker, the lessons are equally unfancy. Don't subsidize FX borrowing through the banking system. Don't promise pegs you can't defend through a full cycle. Build local currency bond markets even if it raises today's funding cost. You're buying tomorrow's policy space. Publish the short-term external debt numbers that matter, by sector, not just aggregate, to keep everyone honest about rollover risk. And when pressure comes, communicate clearly about your objective. Stabilizing functioning markets, not defending a particular line in the sand. And what about investors and households trying to read headlines without drowning in acronyms? Watch 3 gauges. 1, the current account, whether a country is a net borrower from the world. 2, reserves relative to short-term external debt, the Greenspan-Guidotti style measure that asks, could you pay a year's worth of foreign bills if markets closed? 3, the share of corporate and bank debt in foreign currency, and how much of it matures soon. Those 3 won't catch everything, but they'll keep you out of the obvious traps. So, are we repeating 1997? Not mechanically. Balance sheets are stronger, reserves are bigger, exchange rates are more flexible, and regulators know the playbook. But the core temptation, borrowing in someone else's money because it's cheap, never goes out of style. When global rates rise and the dollar tightens the world's belt, anyone who treated FX as an afterthought gets a 1997 flashback. The cure isn't clever. Borrow where you earn, term out your funding, hedge the risk you can't avoid. And remember the law that outlasts every cycle. Debt you owe in your own currency is a policy problem. Debt you owe in someone else's is a solvency problem. If this gave you a clearer map of the trap, stay with money lore. We'll keep translating the alphabet soup, FX, CA, NIR, HT, M, into plain English you can use. So the next time the tide goes out, you're not the one swimming in someone else's currency.